Welcome to the Brain Picker Pro Show, live from Lake Wiley, South Carolina, and all the way up in New York is my good friend Mike Zlotnik. What's going on, buddy?
Hey, Larry. How are you? Great to
Man,
be on your
I am doing
podcast.
good. I am doing good. Thanks a lot for being on today. I really appreciate you taking the time. I know you're very, very busy. You're out there rocking and rolling, making deals, wheeling and dealing all the time, and I really appreciate it. So, first of all, for those that may not have heard of you, I mean, I know you're out there, man. You got a reputation. So, tell our listeners a little bit about who is Mike Zlotnik.
Thanks, Larry. I appreciate your great introduction. I'm known as the Big Mike, the Big Russian. I live in New York. I live in Brooklyn. There are a lot of Russians here. That's kind of part of the problem, and it's both the beauty and the curse. And but I love real estate. I've been doing real estate full time since 2009 and part time since 2000. I did spend 15 years in software development before I got into real estate. And I have a big family. I am married. I have 4 kids and a cat.
4 kids and a cat.
4 kids and a cat. I'm becoming a cat person. So.
Oh man, better you than me. Listen, we have 2, and I hate cats. I'm actually allergic to them.
I'm sorry to hear that. Let me put it this way. I thought I'd hate any kind of a pet until my daughter rolled in with mice into the house, and my wife said, "Let's get the cat."
There you go. That's funny. That's funny. So, Mike, tell us a little bit about your real estate investing experience. I mean, I know you've done a lot of real estate, but you're primarily a lender now, right?
Yeah, I do a lot of hard money loans today, and I've been doing it for a long time. I started my real estate investing in 2000. I bought apartments in Brooklyn. I bought houses in Brooklyn. And for a number of years, I was passive until 2009. And then I became active. I started managing our first hard money fund. We funded a lot of transactional funding deals. Then we went into the extended funding, kind of fix and flip projects. And it is still our core business. We do hard money loans for fix and flip projects, for fix and refi projects. That's still more than half our business. But we do invest also in long-term equity deals. We participate in larger deals. Multifamily value-add projects. We participate in self-storage. We have deals in conversions of old retail into self-storage, ground-up construction of self-storage. We have participation in retail value-add projects. A lot of people nowadays are scared of retail industry. I'm not. If you select the right location and you get a great deal and you have value-add, you can still do really well. So we do both. We do hard money and we do value-add equity deals. That's sort of the core focus today.
That is awesome. So you, I know you loan out your own money. You also have funds and stuff like that now, but you're doing, you said equity participation type deals, syndications on bigger deals. I didn't really know you were doing that much of that.
Yeah. So we do hard money. Today, I co-manage a few funds. We have the income funds and growth and income funds. So income funds are only hard money. And we have growth and income funds, our flagship fund called Tempo Opportunity Fund, and that is both growth and income. So on the income side, it's the hard money loan. We derive double-digit hard money loans, and then on the growth side, we participate in syndication deals. So deals come through various sources. Many of these deals are kind of collective efforts of other funds that we know, other fund managers that participate in these deals. So we typically don't invest just blindly ourselves. We invest with other fund managers who we know pretty well. We do they do their due diligence, we do additional due diligence, and then we participate. And many of these deals, I'll give you some examples. So we have investment into a value-add multifamily project in Chicago. So the property was bought, 344 units, and every unit is getting renovated over a period of approximately 2 years. And then the rents go up on average around 16%. So the opportunity is to find a property in an A area that has B rents and it's a little bit run down. and you renovate units, you build some common facilities like a clubhouse, like a gym, and you improve the whole experience, and you can raise rents. So ultimately, that project was bought for $45 million, and 2 to 3 years later, it should be worth 65 with no normal appreciation. It's all value add appreciation because the income goes up, and these projects trade as a multiple of income. Does that make sense?
Yeah, absolutely it does. But so for the people who may not understand, explain what value add means. The forced appreciation.
Value add is very, very simple. So if you're doing value add on a normal house, you're basically renovating a house and you're selling it retail. You're buying it wholesale, depressed, and then you fix it up and then resell. On a commercial property, value add means you are renovating in a multifamily, an example, renovating apartments. So you have an older apartment, older kitchen, older appliances. Apartment looks dated, and no wonder it's renting below the market. So when you renovate the apartment, you can put a new kitchen, new floors, new cabinets, new appliances. You can increase the rent by, in that particular case, 16%. So 16% increase in the rent, virtually all of it goes to the bottom line. It increases net operating income of a property. And commercial properties trade at the multiple of the net operating income. So imagine let's use an example. Let's just say this property generates $1 million in net operating income. When you increase the rents by 16%, your net operating income doesn't increase by 60%. Your net operating income can increase by 50%, by 40%. Instead of making $1 million, now you're making $1.4 million, $1.5 million. So the value of the property appreciates by that increase in the net operating income. So that's the basics of how it works in the commercial world. When value add happen, it's not just done for the sake of spending money. It's done for the sake of increasing net operating income, increasing cash flow, and then you're improving the community too. Now you have, instead of an aged apartment complex, you have a newer apartment complex with newer apartments, new common facilities. It lifts the whole area up. Does that make sense?
Absolutely, it does. And there's multiple ways to do that, I know. Could you explain some of those ways other than just rehabbing it and raising rents?
Yeah, so it varies depending on the type of asset. So for multifamily, it's one approach. I'll give you examples for self-storage. Self-storage is a different beast. For self-storage, you could reconfigure the units. If an area has higher demand for 10 by 10, you can cut your 10 by 20s into halves. You can add administrative fees. You could do some common area improvements. You could add auxiliary services. So it sort of is the sky's the limit. But as an entrepreneur, you're focusing at the end of the day as the profitability of the project. If you can improve profitability through various techniques, you can increase the value. And on multifamily, as I said, it's not just the unit rehabs. It's also changing overall experience, the image of the property, the common facilities. So that property is adding a laundry, they're adding a clubhouse, they're actually building a gym on the property. If you add all those things combined together, it feels and looks like a better property, and the rents catch up. It might not happen overnight, but over a 2 to 3 year period, you basically improve the property. And the secret sauce here is not to start with the heavy lifting environment. The secret sauce is to start with the property that's trading, it has vacancy, above the full occupancy. So there's a room to go up. So you're starting with the occupancy, say 82%, and your target occupancy is ultimately in the 90s. So you have a little bit of room to increase, but not only you can increase occupancy, also increasing dollar per square foot. So those are the basic techniques. When you're looking for a project, you definitely don't want to have a fully performing, top of the line rehab property, because that's a retail kind of price. What you're trying to get is a discount. So 75% occupancy is fine, 80, 82, 85, as long as you have room to improve and as long as you can increase the rents. Those are the basic things you look at. And the demographics of the area are improving too. If the jobs are moving in the area, then you have more potential for rent increases because the demographics are improving.
Right, and you do that through a feasibility study, and
Exactly.
but like the property you mentioned, once you get all that done, the property's humming, you've got your expenses under control, you've increased the rent, it's in good shape. Then you can sell that property to like a hedge fund or something, and then they're going to hold on to it long term. So you want to be selling that type of property, not buying that type of property.
Exactly. So the exit strategy on a lot of these properties is selling the improved property, fully performing, to the REITs.
Right.
Self-storage is very typical. There are big REITs that come in and buy fully leased out properties. There's another interesting play today in the self-storage happening. There are actually couple of interesting plays. I'm just going to mention this. One is with Amazon eating everybody lunch. Old Macy's, old Sears, old Kmart's, they're all struggling, and some of these facilities are empty. So you can come in and buy a great location, real estate that's completely empty for a fraction of a price, and convert it to self-storage. We are participating in at least one project like that. And it is exactly what you said, feasibility study. You have to do a feasibility study and look at that area and see if that area supports additional self-storage units. So if a feasibility study is strong, then you have very good potential to take that old retail beast that's died because of Amazon and make it into a great self-storage facility. So, but we want to be in that purchase to redevelopment to stabilization phase. Once it's stabilized, we absolutely want to be at a point where we exit. We don't want to carry this thing at a retail price level. So from that's our play. That's the whole play is to be value add component. Once it's stabilized, just get out. Let the REITs because REITs' whole purpose is to yield. They're okay with 4 or 5% yield. We're not, and that's how the play goes. For us, it's good to get out. For them, good to get in.
Well, like you said, that 344 units in Illinois, I believe you said.
Yeah, Chicago.
46 million or something, and then the value add is in the 60s. That's $20 million right there. Boom, and which will probably take, I'm guessing, 5 to 7 years at least.
No, it will take less. What's funny is this. So that particular deal, as an example, the equity. So we love leverage. So leverage could be a very powerful tool. That particular deal was acquired with $33 million, Freddie Mac, great mortgage, and the equity participation was only $12 million. So $12 million will earn $20 million profit over a period of approximately 3 years. So that's, it's not 12 going into 20, it's 12 going into 32, earning 20 million upside. And why it happens? Well, because the property is worth more money, and the leverage helps you. That's where the leverage works for you in a big way.
That is awesome.
And why 3 years? I'll tell you why 3 years. So that particular property, the sponsor of that property has a unique technique. And I don't want to spend all my time on this, but I wanted just to mention this. I've never seen it before. When I saw it for the first time, it's like, wow, this is something I want to invest in. This guy has a technique how they renovate units while people live in them. So what they do is they approach a tenant and they say, listen, you have a lease for another 9 months. What we want to do is have you live in a new unit while with the same level of rent. So all we got to do is we got to have all your furniture moved in the middle. We're going to cover it all. We're going to renovate the whole thing. You're going to stay in the hotel for a night, maybe 2. Sometimes they do it in a day. So they run these renovations 1, 2, or 3 days. A lot of people run through this. It's remarkable. Yellow jackets move in, do their stuff. Yellow jackets move out. Green jackets move in. They do their stuff. Then they move out.
Wow.
So it's big crews coming in, and then they crank through unit by unit very, very efficiently. And the tenant winds up with a rehab unit within 3 days, and they wind up owning it, sort of living in a great environment. On renewal, the rent goes up.
And then they know that.
They know that.
They know that in advance. And they're like, yeah, I want a new unit for the next 9 months without an increase in rent.
That's right. That's exactly. So
I love it. So, Mike, you really kind of cut your teeth on residential stuff, I know, as well. And you still do a lot of residential as well. Tell us the typical type of residential deal that you do, that you fund.
We do a lot of hard money loans on turnkey properties. So you've heard of the term turnkeys. These are some of the properties that you sell. They're typically under $100,000 value, maybe a little over 100. It depends. So some properties that we finance sell to investors, fully rehabbed, out-of-town investors, coastal investors, sometimes foreign investors. And we finance a lot of deals we do with CG guys and non-CG guys we've been working with for a long time. So they'll buy a property for $40,000. They'll do $30,000 rehab, and they'll sell the property for 100. So they'll be all in for 70. They'll sell it for 100, and it'll rent, say, $1,000 a month. Again, I'm just using this as an example. So rent to value about 1% a month. In the smaller markets, the rent to value is even better. So if it sells for 80,000, the rent could be 900 a month. Typically, the smaller you get, the better the ratio.
Sure.
And we'll finance. Typically, on that deal, we'll give the borrower kind of 90% of their purchase, 90% of their rehab. Some of the guys we've been working with for a long time, they have strong track record. We'll give them 100%. We know them so well; they have not failed. And it's pretty much cookie cutter. They know exactly what they're going to do. Their cost per square foot of rehab is very stable, very predictable. And then they turn them 3-4 months, boom, next one. 3-4 months, boom, next one. So this turnkey range is a great range. There's a lot of demand from coastal investors for income property. They love these type of properties, and the variance on them is very low. You're not going to have a $100,000 property selling for 80, nor are you going to sell it for 120. It's going to be plus minus 5%.
Right.
The predictability of these deals is very high.
So what kind of terms do you charge on a typical loan like that, where you're loaning 90% of the purchase and 90% of the rehab, or if they have a track record, maybe 100% of each?
Yeah, so what we do is pretty much we don't negotiate on price. People say, hey, listen, it's competitive, hard money. I tell them, guys, I do this on a relationship. I provide high value and service, and we still charge what we charge in this even competitive markets. We generally charge 3 points, 12% rate on deals sub 100K. You're going to ask me, hey, maybe they're a little bit cheaper money. The price sensitivity to cheaper money is much lower in that dollar range because, first of all, less money is available. All the big boys don't play in the space. All the big hard money lenders, they don't want to deal with properties below $100,000 loans.
Right.
That's one. The second thing is the impact of an extra half a point or a point and a little bit more rate is relatively small because the loan amount is small.
Right.
It is more important for our clients to get great service, get fast responsiveness, fast underwriting, and then fast rehab disbursements. So we disperse rehab funds very, very fast. So the combination of those things make us attractive to the people we work with. We do have products, much more competitive products in price in the bigger markets. So if you come to me with a loan in New York or Los Angeles, we have very competitive sources of money. We either originate and sell the paper to secondary markets, or we have relationships with other players who will make those loans. And those loans can trade anywhere between, say, 1.5, 2 points, and the rate could be 9.5, even lower, depending on the market type of a deal. So we have access to cheap, significant amount of money on bigger deals, and we do them from time to time. But we don't want to deploy our own money, our own fund money into these deals. There's not enough return on them. Does it make sense?
It absolutely makes sense. It really does. It really does. And I got to tell you, when you mentioned a minute ago, 12-3, that's very reasonable. Nobody should complain about that. I mean, we charge 12-5. Okay. It used to be 15-5, right?
Yeah, it used to be. That's right. It has come down, and we generally, we sort of bottomed out our price. We just don't want to do deals below that because not enough return. There's some people who charge still 3 to 5 points, and on the relationship, it makes sense. If the deals are juicy enough, people shouldn't complain. If they like working with you, then it works extremely well.
Absolutely. Absolutely. And like you said, there's something to be said for the relationship. That, to me, is just as important as getting the money, is having somebody they could call you and say, Mike, I really need this draw. Contractor's going out of town, or I got a closing tomorrow, or whatever. It's very, very important to build that relationship. And, Mike, I want to switch gears here a minute. I know you, I've known you for a long time. You mentioned CG a minute ago. A lot of people may not know that term, but that's collective genius. You and I are in a mastermind together. And I think we've been in it about the same length of time. I've been in it almost about 6 years now. And I know you've been in it.
Yeah,
if that
right
long.
around the same. Yeah, it's been a long
Yeah.
time.
Yeah. So, and it's not a cheap mastermind. It's $25,000 a year. And, now, fortunately, you and I got in it before it was that expensive,
That's
right?
Yeah, yeah.
But
We got grandfathered with a lower price point, but
exactly. And as long as we stay in, right? But anyway, you've always been the guy that people would come to if, like, I'm working on this complicated deal, I need help with, how do I put this together? How do I make money on this deal? I mean, I've even come to you with like some loans I've made, in Illinois. I remember us talking about one of those, how do I resolve this problem? Because you're my go-to guy, So do you have a story or a deal that you put together? It's like, man, I never thought this deal would come together, or this is a very complicated deal, or I turned lemons into lemonade or something like that. Do you have one of those kind of deals?
Oh, Larry, it's a great question. I've had a number of the very interesting deals.
I bet so.
Yeah, one comes to mind. I helped a client make only 650,000. That's all.
Only 630.
650,000 only. Well, it's actually cost him around 20-some $1,000. Yeah, so I recollect a flip, a good friend, and he's a great friend. I've been working with him for a long time, and he's now an investor. He's given us a lot of money into our own funds, and he invests into a number of our deals. Before he used to borrow money. Now he doesn't need the money anymore. He's made enough. So he's a money investor now instead of a borrower. But here was a deal. He had a property in California on a short sale. He locked it in for slightly over $930,000. He's in the Bay Area. Stuff ain't cheap there. So
right, exactly.
So he had a short sale contract, and the bank sent a BPO agent. It was funny how the banks were so stupid. They would send a cheap BPO agent to appraise $1 million+ property for $150. And then he came in, out of town agent, didn't know the market, appraised it. So he got approval for $930,000. He didn't think he was even going to come close, but they approved him for $930,000. So to make long story short, he found a buyer who paid him $1.6 million. So it was over $600,000 spread, and the deal was falling apart at the last minute. The reason for this is because the property was in a trust, and people were freaking. Some of the closing agents were freaking out about trusts. So he calls me. He was on a cruise. He was boarding a cruise. He says, "Mike, my deal is falling apart. It's $600K plus. Help." So I picked up a phone. I called a couple of good closers we've known for a long time. The trust by itself is not problematic. A lot of people close trust deals for a long time until there was some psychological fear, and a number of closing agents start bugging out for whatever reason.
Right.
So I picked up and I called one of our old standing relationships, and she said, "Send it over. I'll close the deal. I'll charge a little more for the urgency and for the deal." And she did. She, I think, charged two insurance policies, a few other things. But on a grand scale of things, it was nothing. We funded the deal. Right. We gave him a bridge loan to close on the property. And we did earn our 2%, 2 points fee. And he wound up with a net profit. I think it was between $600,000 and $650,000. And if it was a couple of minutes later, he wouldn't even be able to communicate. The cruise was literally sailing away, and I was able to get him to help to get that deal done. So that wasn't any fancy engineering, but it was more of a coordination, helping him coordinate a deal that was at risk. And I do this from time to time. I talk to you. I talk to a number of other CG, mastermind, not non-CG guys, and I try to provide kind of good feedback. I should be charging for this, but
you should be. You just said, "Okay, I'll work this out for another 2 points," right?
Something like that, yeah.
That's good. So, as a hard money lender, underwriter, someone who takes other people's money. Now, we used to do that. We don't do that anymore. But, I know you do that. You have a couple of funds and, like this syndication equity fund. And you also have, short-term and longer-term residential deals you do. As somebody who underwrites and actually is investing other people's money, what do you look for in a borrower or a deal? I mean, what's more important, the deal, the credit of the borrower's experience? I mean, because listen, Mike, you invest a lot of money for other people, and you got to make sure not only are they getting a return, but job number one is they don't lose money, right?
Right.
So what do you look for in a borrower that that you're investing their money for a deal?
Larry, it's a great question. So we start typically, and again, the way the funds work, let me just say a couple of words. We have many investors, and we invest into many deals. It's a many to many. We run 506 Reg D funds, and many investors participate. They trust their money with us, and we have the responsibility to deploy the money on deals. And on the underwriting side, what we do is we start always with the borrower. It's not. It's requirement number one. We get cold call. I ask people, where did you get my phone number? Where did you get my email? How did you find out about us? And they say, well, I found you on the American Association of Private Lenders site. That's not a good referral. I mean, we are listed. We are members of AAPL, but I'm looking for a warm, strong referral. So
Right.
I could say thank you. We could take a quick look at the deal, the numbers, but in general, if there's no strong referral, we won't take the deal. That's the number one requirement. So what does that mean? It means a CG guy who knows another rehabber who's been working with them for a long time. We have a strong relationship. They say, I've done 20 deals with this guy. He needs some more hard money. Can you help? That's a good referral.
Right.
So we're looking for these type of relationships. That's a step number one. We could do a quick background and credit check, but a strong word of mouth from somebody who we know helps,
Right.
goes a long way. The step number two, we're looking at typically the deal itself. So we're looking at the loan to value ratio. We're looking at the likely resale price. What are the risks associated with the property? Is it a high end, low end? What's the volatility? Scope of the rehab.
Right.
If rehab is pardon me, big ass rehab, there's a lot of risk involved with the type of work. I mean, there's some projects so on steep hills, and you have to build foundation, a lot of stuff associated with that. And if you're dealing with that type of project, there's a lot of risk. If you're
That's so true.
a carpet and paint, easy, walk in the park. So we look at the loan to value, we look at the scope and complexity of the rehab. We're looking at the ARV, likely ability to sell. So it's a deal specific underwriting. And if we like that, right, at that point, we start figuring out contingencies. Are they going to sell in 4 months? What happens if they don't? And if the deal looks good, then we talk about pricing. Some people call me, but what do you charge? I charge $1 million before we start the conversation. That's it. You want to talk to me, pay me $1 million. I mean, seriously.
Yeah.
But it's if you have a good referral, we'll talk to you. We'll work with you. We do want more business, but we want quality business. And I'd rather do more deals with the same people and maintain good service than take onesie twosie. So honestly, if somebody's listening and they don't have a strong referral, I appreciate you not calling. So.
Man, I love it. I love it. That is great. I love to get the calls where people are like, hey, I found you on this list or whatever, or I did a Google search and I found you. And first of all, what's your prices? And I need to close tomorrow because 3 other lenders turned me down. Right?
Yeah, I just love those calls. Well, I got to close in 2 days. Yeah, if you waited so long, you're such a brilliant person to wait until the last minute. I can't help you. I'm sorry. I just can't. I can't do fast. I can do slow. I can do good service, but I can't do. We actually we respond to repeat clients of many deals on a short notice. They grab the deal and I got to close in 3 days. We'll respond. But if I know you, if I have a relationship with you, if I don't know who you are, you want a 3-day closing, call somebody else, please.
Yeah, exactly. And listen, you've built your business based on that whole philosophy, which is very, very important. The thing I've learned in the past is the person who needs the money the fastest, they're also going to nickel and dime you over the rate. And they're also the least qualified borrower and have a deal that probably doesn't even make sense, right?
Yeah, if people bring deals in timely manner, we have access to incredibly competitive money if they have big deals and they're very price sensitive. And there are people who are very price sensitive. I've had those borrowers, and they're great borrowers. We'll get them the greatest rate we can, at least very, very competitive rate. But people come in last minute, something's wrong with the deal. That's the 90% of a chance. It's either the deal is wrong, they're wrong, something's wrong. Just got to go find it. That's why I don't really want to waste time on a 3-day funding request unless it's coming from somebody who I know, and then at least I have the track record that I worked with the person in the past.
Exactly. And you know what, Mike? That's one of the things I've always admired about you is you know how to put a deal together that actually makes money, right? You're going to make money for the borrower and for your investors as well. And it's as if you were investing your own money, so you're making money for everybody involved. And if you turn down a deal, it's because it's not a moneymaker or it's not the right borrower or the right property for them. But when you do a deal, you're very conservative, very cautious, but you can do deals for the right borrower at the right property.
Yeah, that's right. So, part of the business is a diversification play. So as a fund manager, on one hand, we have underwriting process, and I have chief underwriter who runs all the deals. So at this point, he's been with me since 2010. He's a very experienced guy who runs all our underwriting. But on a fund management side, my job is to diversify, and bad deals will happen. From time to time, some will go wrong. Even with a good person and a good deal, something will inevitably happen. So diversification strategy is what mitigates the risk. No matter what, if you have 100 files, a couple of them go bad, no big deal. So that's as simple as that. That's why we like a lot of small deals. So from our perspective, we like an average deal, 100K, perfectly happy, 70K, perfectly happy. So, but on a fund level, it's pretty basic stuff. We try to limit the biggest deal. We diversify as much as we can. We diversify between type of borrowers, location, loans, areas, and then on the equity side, same thing. We diversify as much as we can. We do a lot of deals on the equity side with strong cash flow to start with, so we put a little more money into that, but there are plenty of ground-up construction deals. We'll put a little less money there. So ultimately, I can't find a better word as the word diversification. I have this book out. Let me show you the book. Where's my book? There's the book right there. It's called How to Choose a Smart Real Estate Investment Fund. I wrote this whole book about investing in a fund and asking the right questions and analyzing kind of individual funds that invest in this type of deals. So I'm not promoting the book. I'm just saying that there's a lot of thought has gone into the process of fund management and underwriting.
Exactly. That's awesome. And you're really, really good at it. I've got a copy of it somewhere here in my library. I couldn't get my hands on it right this second probably, but I've got a copy of it as well. And, it is some great information. It really is. And one thing I do know is how to put together a money-making deal. That's for sure.
Yeah, I appreciate the kind word. I'm happy to, by the way, the book is available for free if people would like to download it on Amazon. They just got to go to Amazon.com, search for Mike Zlotnik, or type in how to choose a smart real estate investment fund. And it's available free in Kindle. And if they want a hard copy, they just got to pay for shipping.
That's awesome. That is awesome. And it's got a lot of really, really good information in there about return on investment, taxation, liquidity, fund fees, and management team experience, deal flow. It's got a lot of good information in there.
Yeah, it's the due diligence for somebody to invest into a fund. I've put together this list sitting at a conference a little over a year ago and listening to many fund manager pitches and individual deal pitches. And as I was listening through, I was thinking through due diligence process. How would I select? How would I go through my own due diligence process, investing through those? And I put together a short book. So this book, as you know, put together working with Corey Boatwright, and it's put together as an interview. Originally transcribed the call, and then the book is literally a transcription of the call. So
that's great. That's really good. Yeah, guys, run over to Amazon and grab a copy of it. Like Mike said, it's free, right?
It's free, yeah, on Kindle.
Wow, on Kindle. That's awesome. That's awesome.
Otherwise,
So
it's
run over there
free. I
and
think the Amazon
grab a
charges
copy of
whatever
it.
the fee, like $7 would change. That's
Yeah, Mike Zlotnik, Zlotnik, how to choose a smart real estate investment fund. That's awesome. So, Mike, man, I really appreciate you being on today. If somebody wanted to reach out to you to learn more about everything that you do, and opportunities working with you, how would somebody reach you?
Sure. So our primary website is tempofunding.com, from the word temporary, TEMPO, tempofunding.com. Another way to reach me is to remember bigmikefund.com. This is the podcast that I run called Big Mike Fund. And when you type that, bigmikefund.com, it'll actually take you to the same website, tempofunding.com, but a podcast page. So that's the way to reach me.
That's great. And you do a podcast as well. And, guys, be sure and listen to his podcast. It's all about real estate and he interviews other people as well, similar to what we do. And so, yeah, Mike, I really, really appreciate you being on today. Appreciate you sharing all this great information. It's awesome information. You're really good at what you do. And I can see now why you're so successful.
Larry, I appreciate having me. I'm grateful, and we just recorded an episode with you being on the podcast, on my podcast. It's coming out a little bit later. I have to check with the people who launch it, but as soon as possible. Thank you for coming on my podcast as well.
That's awesome, and thank you so much for being on the Brain Picker Pro show. I really appreciate it. Thanks a lot, Mike.
Thank you, Larry.